Hello, everyone. Long time no talk. Wednesday, March 27. Tremendous space in the store. My longtime friend and one of the sharpest analysts on the street, John Roque, is in the house. And I don't know, John. We could talk about. I guess before we get to the important stuff, or why everyone's here. Good to see you. Good to talk to you.
Thanks, George.
I know it's opening day tomorrow with the Yankees, and as you know, I've been fixated on the Celtics, who no one seems to be able to come close to. But what's your 2 cents on the Yankees? I mean, everyone's calling the Orioles to crush it this year, and your 2 cents on the Yankees, and as a longtime hoopster observer, your thoughts on the Celtics.
I'm going to start backwards. I think the Celtics are the class team in the league. There are a lot of other good teams. The other night they had a stinker against the Atlanta Hawks after being up by 30. They lost that game, but even teams in first place get to have a stinker every once in a while. But I think the Celtics are the favorite to win. I'd like to see some other teams go deep into the playoffs like the Dallas Mavericks because I think watching the Wizard, Kyrie Irving, of course, and Luka Doncic is a fantastic player, but watching Irving is just a joy. And then with respect to the Yanks, their top pitchers out, Garrett Cole. Marcus Stroman doesn't want to throw to start the season as the opening day pitcher. So I think they're going to have some things to work through. They picked up an infielder today by the name of John Berti, Berti, who comes from the Marlins. 2 years ago, he led the majors in steals. So I think we should have kind of a little bit reduced expectation for the Yanks, and I think the O's are going to be really strong. They got a lot of good players.
It's amazing how they've come back the last few years. I mean, there was a time when you and I were young, once upon a while, that the O's were a class act, and it's been a long walk in the desert for them. So
yeah, they've had some lean years, but they're good. They got a lot of good young players.
Yeah, it's amazing. Anyway, good to see you.
You too. Thanks.
Yep. Crazy times as usual. You've got a wealth of charts and information to impart upon us, so we'll get into it. But how about I don't know, what's top of mind for you? What's high conviction for you? What kind of stands out? I mean, we're in this market which seems to endlessly go up, and everyone's talking about liquidity. And I was really struck by the presentation you did last week. You can get into your Willy Wonka story, et cetera, et cetera. But I guess sort of overall, what are your sort of highest held convictions, and what kind of strikes you about the current environment?
Okay. Thanks, George, for the kind intro. So I'm going to go over some of the themes that I've been going with and that I'll continue to go with until they change. So if you'll allow me, I'll probably take maybe 2 minutes or so to go through this, and then I'll throw it back to you. Okay, so here goes. It is no secret that the market is overbought across the board through all periodicities. No secret. It's no secret such that nobody should be surprised by a pullback. Nobody should be surprised. In fact, it was the Gap Band who sang a song in the early 80s entitled The Sun Don't Shine Every Day. So we shouldn't be surprised by any pullback. Nobody should. However, new highs are consistently above new lows on the New York Stock Exchange, which tells me that I need to concentrate my efforts on the long side, not on the short side. And cumulative breadth has made a new high. So pullback should be well contained. The cumulative breadth advance to a new high should dispel any notion that the rally has been narrow. In fact, the rally's been quite broad. I prefer non-growth over growth here. My three favorite sectors coming into the year were and still remain financials, healthcare, and industrials. That's not to say that tech's not a great sector, but I didn't think I could do anybody any justice, and of course, mostly myself, by just identifying tech as being strong. I thought I could probably hit a ball into the gap by going with financials, healthcare, and industrials. Healthcare moved to a new all-time high. Industrials are the strongest. Industrials are the second strongest internal sector at an all-time high, and financials are right at all-time highs. That's the internally it has the strongest scores on my work. And then I want to be long the Russell 2000 IWM. I've done long-term study going back to the 1980s. I've looked at every bull and bear market in the Russell 2000. This is easy to say. When a bear market ends in the Russell 2000, a bull market begins. The smallest advance for all Russell bull markets since the early 80s is 75%. The shortest bull market advance for the Russell 2000 going back to the early 80s is 10 months. I'm merely looking for a target at the old highs of 2,400, which does not even make the smallest of all historical prior bull market advances. So I think it's quite reasonable to say that. I've been long Europe. I want to stay long Europe. If Europe's in a recession, son of a gun, Germany doesn't know it. France doesn't know it. Italy and Spain don't know it. And the UK is pretty close to breaking out of a big base. I want to be long Japan. I realize I've made some mistakes over the last year, but I think I did the best job best job for myself and for my readers and people I speak with by identifying Japan as a bull market advance going back to last spring and saying then that it would make an assault on and make a new all-time high, and I got lucky with that one. I think China and Hong Kong are bottoming. I like gold, I like silver, I like copper, I like palladium, I like oil, but the commodity market is not homogeneous, nor is it monolithic. But gold is the best of them all, Xing out cocoa, which is this asset class's version of NVIDIA or Meta or SMCI or MicroStrategy. And I have believed for some months going back to the late summer that yields are topping. It's probably hard to see on the U.S. Yields if you look at them one at a time, but every yield on the U.S. yield curve is below the Fed funds rate. That usually tells me that yields are topping, and yields in Europe are even more advanced in their topping phase. So if you're a fixed income investor, I want to buy bunds, I want to buy oats, I want to buy gilts, because yields are going to continue to work lower there. And with respect to the dollar, I'll only say the following. The dollar yen is the most interesting relationship among the currency crosses because if the dollar yen works and breaks out convincingly above 150, it completes a 37-year Brobdingnagian base. And I would estimate, if that's right, that the dollar yen target could be around 200. But if it fails, I'll change my mind and I'll try to alert people who are paying attention. But just take a look at the monthly chart for dollar yen and you'll get a feel for it. So those are the headlines, George. If you want me to just touch on sentiment, I'll do that quickly.
Yeah, John, maybe that's a good place to go. In particular, it may be a good lead into your sentiment, good lead into your idea, your Willy Wonka theory, where everyone's like, well, the market should correct, blah blah blah, and your idea about being contrarian on that. So why don't you go down that route? I thought that was extremely interesting observation on your part.
Okay, thanks a lot. So so I had a webinar a week or so ago, and it was entitled, just using the Economist's cover for March 2nd, how high can markets go? And I said the market is overbought, true across the board. We should have a pullback, makes sense. And then I said that I've heard everyone is bullish, and my reply was, I don't think so. I've had more than 50 in-person meetings and Zoom calls so far in 2024, and I do not find everyone to be bullish. Of course, investors are better off than they were in October of 2023, but I don't get the sense that there's a lot of bullishness. For example, John Templeton famously remarked, bull markets are born in despair and they end in euphoria. I don't think it's euphoric. Everyone knows about Bitcoin and NVIDIA and MicroStrategy and SMCI, but how many know consumer staples are close to a 2-year high, that the financial sector is at its all-time highs from 2022, that healthcare and industrials are at all-time highs and have been so, that the material sector is 1.5% or 1% from an all-time high. So I don't think people are recognizing that. And I'll tell you, the biggest pushback that I've gotten over these last several months has been that the market advance is narrow, and I don't get that sense at all, at least as I measured via cumulative breadth. I said, also, I find more active managers than ever don't get their clues from price action and the market, and instead get their clues from the Fed and only the Fed. And then my last sentiment comment before I get into the Willy Wonka thing is that I found that there are two types of bears. Bears because they are nearly always bearish and they find reasons to be bearish like debt levels. This time it's the inverted yield curve, geopolitics, Ukraine, Russia, and what's transpiring in the Middle East. And then the second group of bears they're bearish because they missed the rally and they say, I want the market to come in so I can buy the pullback. So I don't get the sense that everyone in quotations is bullish. And I don't think it's euphoria. I really don't. I was there in 2000. That was euphoria. It doesn't have to repeat in detail, but this is not like that. And then George was kind enough to mention a report that I sent out in early February. On February 4th, it was entitled Willy Wonka Was a Contrarian. And the book was Charlie and the Chocolate Factory, of course. And Willy Wonka, as the author Roald Dahl said, oh, you should never, never doubt what nobody is sure about. And I said, applying that to the market makes me think on February 4th that we should, at the very least, consider that the market can continue to accelerate higher, such that it reaches excesses that nobody is sure about or that nobody has seen for a very long time. Now, the history I found is limited, so I can't admit it into statistics class, but I can admit it into portfolio management class. And then in addition, I used a line that was a line from my former partner Steve Shobin. Steve Shobin, when we worked together at Lehman Brothers, he said, momentum begets more momentum. And then I wanted to explain. So here goes. What we've experienced since October, and when I wrote this, it was through the early part of February, was what I would characterize as a momentum thrust. Now, perhaps there are some people on the call that would agree or disagree, but this is the way I characterized it. And through that time, early February, the S&P had been up for 13 or 14 weeks. And within those 13 weeks, it had a 9-week winning streak and a 4-week winning streak. I'm big on streaks because it shows us that there's something powerful occurring. We like streaks when our favorite teams go on winning streaks, so I don't see why it's any different with respect to the market or stocks. And then I found 4 similar instances, again, not admissible in stats class, but certainly for PM class it is. From early December 1960 through early March 1961, the S&P was up for 12 or 13 weeks. It added 13%. The S&P stayed strong through the end of December 1961, adding another 13% from early March 61 and through the end of the year. Okay, so that's number one. Number two is March 8th, 63 through May 10th, 63. The S&P was up for 10 weeks in a row, gaining 9%, and then it pushed higher for 2 more years, adding 25% in the process before it had a 1-month correction of 10%. There was a bear market thereafter in 66, but there was quite a long time before the market came under big pressure. And then, of course, you had October 4th, 85 through January 3rd, 86. This was perhaps the most powerful because the S&P was up for 13 or 14 weeks where it gained 15% and then added 17% into the end of 1986. And then, without too much of a breather, it added another 36% until the 3rd week in August 87, which was the market's peak and preceded the crash of 87. And then the last one I found was late November 2003 through early March 04. The S&P was up 13 or 15 weeks. It added 9%. And then through the end of the year, it only added another 5% base through 05 and then gained 22.5% from November 05 until the summer of 2007, which was where the market peaked before anybody had an inkling about the oncoming GFC. The message here is that the momentum thrust historically said that the market did stay stronger for longer than most would have imagined. And of course, there was a big corrective phase, but it wasn't until much further out. So for those who are expecting some big corrective phase here, sure, it could happen. But the limited history suggests it is probably not likely, especially since we have new highs consistently above new lows, and cumulative breadth has confirmed the advance. Thanks, George.
That's fantastic. For those of you who are visual learners like I am, I put a bunch of John's charts in the nest. They may be hard to read, but John, the one I really want you to focus on in the context of what you just said, you have a chart in here which shows, there's 2 charts actually. One showing, I don't know if you can see it, but your cumulative new highs, outpacing cumulative new lows. And and explain. And I think you said to me in the past, when new highs are outpacing new lows, it's hard to make money on the short side, and vice versa. And the other one is you have a chart showing just total breadth, and those are both they're speaking very powerfully to the upside, aren't they?
So I'll start with the breadth one. The breadth one is the easiest of all technical constructs, and anybody can do this in their own portfolio. You just take the daily closes for all the stocks you own, figure if they're higher or lower than the day before, and then you can have an if statement to fill in your column in your spreadsheet, and then you can have a breadth indicator for your own portfolio. I actually suggest this for institutional accounts that I meet with. And if they want to make it easier on themselves, they can do it on a daily basis. But George is right. Breadth did make a new all-time high. Now, I'll tell you, and maybe this is me proselytizing a little too much, but there was a bear market in 2023. It was a bear market in basics. There was a bear market in small caps, utilities, real estate, staples, biotech. There was some really bad action internally. It was covered by 7 or perhaps 2 handfuls of stocks. But until the October low, there was some really terrible action there. And I will also tell you that cumulative new highs for the NASDAQ continued to deteriorate despite NASDAQ rallying 40%. That's never happened according to the data and the history that I have. So last year was not an easy year. But I think since the October low, it's been a little bit easier because breadth has advanced sharply and you're getting more new highs than new lows. And to me, the new highs, new lows indicator is probably as important a market exposure indicator as there is out there. When new highs consistently outnumber new lows, we're all pretty good stock pickers, but we're all pretty rotten stock pickers on the long side when new lows are consistently greater than new highs. And so that's where we are here. And I have the data that I've been inputting by hand. Laugh if you must. I still do it to this day, inputting by hand since the early 90s. And you had big turns upward in this indicator in January 95, June 2000, March 03, April 09, October 11, May 16, January 19, May 20, and then December 2023. So as long as new highs consistently outpace new lows, I'm going to focus on the short side. And if it changes, I'll kneel at the new lows church, but not yet.
Makes sense. So, John, just going a little bit further into the weeds, a couple of the other charts that I put in, I don't know if you can see them, but you've got your another differentiated call you have. You mentioned at the top, growth likely to underperform non-growth. It's up on the nest for everyone who wants to see it. And that chart you can see it clearly rolling over. And then also your chart just of non-growth period. Maybe you want to explain what this is. I think you added, what was it, energy, financials, industrials, and materials together. So let's talk a little bit about the rotation you're seeing in the market. Like, the first shall be last and the last shall be first. I mean, it sounds like it's a pretty high conviction view of yours, no?
So I sent out a note to clients, I guess it was 2 weeks or so ago, in which I entitled it "Blasphemous Rumors," which is a song from Depeche Mode in 1984. I won't upset your listeners with me repeating the lyrics, but suffice it to say, I maintain a growth to non-growth ratio. I don't do growth to value because as a technical guy, I didn't want to define value, but I did it doing growth. And anybody can do this. It's easy. In the numerator, in the growth portion, the numerator, it's merely 2 ETFs, XLK plus XLY. That's tech plus consumer discretionary. And then in the denominator, I have basic materials, energy, financials, and industrials. That's XLB, XLE, XLF, and XLI. And if you want to create this trade yourself, you just do it with equal dollar increments in the numerator and the denominator. And when you create this ratio and you plot it over time, you get a long-term look at this. It peaked in March 2000. Growth peaked versus non-growth, and then non-growth outperformed for 8 years until June of 2000. The ratio was down 69% in favor of non-growth, and then growth killed it from June of 08 until October of 2020. That is still the peak in this ratio, growth to non-growth, October of 2020. There was a lower high in November of 21, where growth made a lower high relative to non-growth, but the momentum had peaked much before that in 2020. And this time, again, we've gotten another lower high. Pardon me. We got a turn down in the momentum indicator I maintain on this growth to non-growth ratio, and it's rolling in favor of non-growth. So it just says that the momentum is not as strong for growth relative to non-growth, and I'm probably doing better with non-growth as a whole relative to growth. And as I mentioned, industrials are at a new high, basics are close to a new high, financials are right at all-time highs, and energy's close to another breakout. So that's the non-growth component that I care for more than I care for growth here. And growth, as you know, of course, is dominated by the Big Seven, Magnificent Seven, and that group is no longer monolithic because Apple and Tesla have weakened importantly. And then I combined the energy, financials, industrials, and materials into one index. And George said he put the chart up, and it's at a new all-time high and has stronger momentum here than does the growth component. So that's kind of the genesis or the supposition of my belief that non-growth can do better than growth here.
So, John, we almost put in blasphemous beliefs or whatever for the intro song, but I kind of more partial to Randy Newman.
Yeah,
Randy Newman, your short people piece from recently in the last few weeks. So you use that, I think, as an intro to your call on the Russell. I took your chart and put that up on the nest as well. So what's your view on the Russell right here in the smaller cap names?
Okay, so I got lucky a few months ago because I had done, as I mentioned, a long-term study on the Russell 2000 going back to the early 80s. And again, as I said back then, when a bear market ends in the Russell, a bull market begins. And there have been 11 prior bull markets. The average advance for a bull market in the Russell going back to 1980 is 131%. The median advance is 108%. The maximum is 314%. And again, the minimum is 75%. I always work with the minimum. I never work with the average. And so I thought, my gosh, if I'm going to get 75% on a historical minimum, I think it's not a big stretch to think that the Russell can get back to its former highs at 2,400. So I've been reiterating this idea since December, and then I finally reiterated it most recently by using the Randy Newman song "Short People." So I think the Russell's in a good spot. It was up 1.6% today. It was better than the S&P and better than NASDAQ. This is just another kind of thing to pay attention to. And I think there's a good chance it gets to 2,400. But I will tell you, without equivocating, I'm going to use a Milton Friedman quote. Milton Friedman told us inflation is always and everywhere a monetary phenomenon. Extended for my purposes, the Russell 2000 is always and everywhere an IWM phenomenon. And that is because hedge funds are always short the IWM versus their bigger cap longs. So in order for this to really accelerate, those shorts have to be taken in. And here's why. Because nobody in their right mind is going to sell 20% of a Big Seven stock and say to their analysts or attendant PMs, go out and find 300 small cap stocks for me to buy. Nobody is going to do that. But they will adjust their exposure or alter their net by reducing a short in the Russell 2000 IWM or adding a long in using that same instrument. So to me, it always starts via the IWM. It never starts from the individual stocks just because it's too hard to satisfy your market cap thirst with small cap stocks.
That's on nobody's dance card. Talk about people being out of position. I mean, that would be majorly pain for most institutional investors if that were to come about. So, wow, interesting. Let's moving further afield, a real tour de force here as we go around the bases. Let's touch a little bit more on the gold chart. I put it up in the nest that gold. I know you've been a strong supporter. It's really in your groove right now. But the commodity complex generally, gold, oil, copper. It's not monolithic. I get it, but how's the whole how's that whole complex shape up to you?
Okay, so if somebody on the spaces wants to do it themselves, they can do it, and I'll tell you how to do it. Just go back to 1960 to date and plot on the same chart. You have to do it on separate axes, of course, gold and the Bloomberg Commodity Spot Index. And you'll find that gold and the Bloomberg Commodity Spot Index have been pretty closely tied from the early 60s until what has been the most recent period when since the commodity index peaked in late 21, early 22. Since that time, gold has been a conspicuous outperformer. And now, of course, gold is at new all-time highs. But the Bloomberg Commodity Spot Index has not yet corroborated the advance. Just give me a second. I'll try to get to it. Gold is the king of all commodities. There's never been a commodity bull market without gold. Does this mean all commodities have to participate? I don't know. I'm not of the opinion that we should use the following equation when we do our trading. If we see A and we see B, then we should buy C or sell C. I don't believe that's the way the world works. I think if you see A, you should buy A. If you see B, you should buy B. C might never occur. We might have to solve for L or P or Q or Z. So gold's working. The commodity complex broadly is not. That should not prohibit me from owning gold or some really terrific looking gold stock. So I really like gold. My first target for gold is 24.44, and the way I get that target is the former high for gold was 20.64. The bottom of the range, as I saw it, was 16.84. 2064 minus 1684 gives you 380. Add 380 to 2064, it gets you to 24.44. And I think you're going to get it. Gold's completed a 3.5-year big base, so the big base potential has been realized. It's out, and on a monthly basis, which I think is the most powerful signal of all, the momentum indicators continue to advance. They're not overbought, and gold has been, since the early 70s, a big base and breakout asset. Let me just give you the details. Gold broke out of a big base in the late 70s, and then it went up from $180 at the breakout to $650 in 16 months. That's 260%. And then gold had a small base from the late 90s through the early 2000s. It broke out at 335, and it went up to 670. That's 100%. And then gold finally completed a 27-year Brobdingnagian base from the early 80s through what was about 2008 or thereabouts. Gold broke out above 660, 670, and then went to 1920, up for 190%. And then the last base and breakout, the base was kind of from 2012-13 through about 2018. Gold broke out above 1350 and then rallied 50% into 2075 when it had its former peak in 2020. And now it's out again, and gold's only up about 7% following the breakout at 2050. So again, my target's 24.44.
Got it. Makes sense. John, there's one chart we didn't touch on. I don't think we glossed over it, but it was important enough we decided to put it up. And that was, I think, the banks. One of the old rules that you and I were brought up with, or rules, one of the old axioms was, for the market, if financials aren't doing well, the market can't do well. But clearly that hasn't necessarily been the case more recently. You have a chart, and it's up on the nest of the various global bank indices. It's most noteworthy how badly the U.S. banks were doing. They're doing a little bit better now. But any thoughts on the banks? And more importantly, how do you rationalize the significance of the bank price action vis-a-vis the more broader market?
Okay, so I show a chart in my presentations, and as a chart guy, I got to say it's a pretty decent chart. It shows the S&P financials, which is the XLF if you want, the KRE, which is the regional bank index, and then the BKX, which is the KBW bigger bank index. And if you go back, a decade, whatever, we could go back for a much longer time frame. The S&P and the financials, and of course the KRE and the BKX did trend over time together, pretty darn closely. And it was pretty hard to have a big advance in the S&P if banks did go down. I still think that is likely the case, that banks can't go down. They don't really have to go up a lot, but they cannot go down. But since the end of 2022, 18 of the top 20 performers in the S&P financials are non-banks. So perhaps the market is telling us, and we have to have an open mind about this, that the banks are no longer as tightly aligned with the S&P 500 because non-banks are the leaders in the sector. And again, and I wouldn't have told you this back to the GFC because I thought at that point that Citigroup was the most important stock in the world. And when Citigroup failed, it was all over, and the banks as well back then. But right here, as long as the banks don't go down, well, then the market should get the benefit of the doubt, and it is fairly well insulated. And then George mentioned global banks, and the chart is up there. Thank you for putting it up there. And the chart shows, and if you take a look at it, you'll see this, that I have the BKX, the European banks, the SX70, the Topix banks, which is Japan, of course, the Canadian banks, the FTSE banks from London, the Australia financials, and then the Hong Kong financials. Now, of course, the banks in Japan have been the best banks index itself in the world as far back as I have this chart up, which is 12/31/21. The banks in Japan are up 114%. The European banks, again, there's supposed to be a recession there. They're up 38% over this time. FTSE banks are up 24. Aussie banks are up 14. Canadian banks are flat. And then, of course, the Hang Seng banks are down over this time. Now, the Hang Seng banks are down about 17% since 12/31/21, but there's a good reason for that. The Hang Seng banks and the Hang Seng proper has been in a bear market for 72 months if you're being kind. And if you're being critical, Hong Kong's been in a secular bear market for 16 years. And despite the fact that Hong Kong has been in a bear market for the last 72 months, the Hang Seng banks are in a better position performance-wise than the KBW Bank Index. So our banks have some issues, but so far they haven't been issues enough to hurt the market. And I will tell you again, as I mentioned earlier, there was a bear market in 2023, and it included the banks. And I have a long-term chart for the 10-year Treasury yield, which goes back to the early 70s. I have a much longer chart going back to the 1600s, but back to 1970, that's it. The 10-year Treasury yield is an undefeated indicator. Every time it has rallied, something has broken. Every time it's rallied big since 1970, something has broken. And there were banks that broke last year. And I'll tell you what my mistake was. My mistake was that I thought it was going to have a bigger impact on our market, specifically the indexes. But it did not. And, that was a big mistake. But I'm going to say that as long as the banks don't go down here, the S&P or the market is generally well insulated.
Makes sense. So, John, let me ask you something. I'm going to be guilty of if A, then B, if B, then C. And you would say, no, just do A. So let's take your views on gold, which charts look great. And do you dare venture a view on the dollar? Historically,
Okay.
one would say, gold up, dollar down. But
Yeah.
you want to go there, or you want to stay away from that?
So I know the history, as you've alluded to, since 1960, the gold has had its best historical advances when the dollar's been weak. I'm aware of that, but I don't know in this environment that the history.
Did we lose you, John?
No. Are you there?
We lost him. By the way, if anyone has come waiting for John, John, we can't hear you. I don't know if you fell off. Are you there, John?
I'm here. Can you hear me?
Yeah, we lost you for a second. You said you were aware of the historical relationship, and then you blacked
Okay.
out on us.
Okay. Thank you. I'm aware of the historical relationship for the dollar and gold going back to 1960, and gold's had its best historical moves when the dollar has been weak. So I'm with you there. But I'm going to say something that might not sound great to the people who are participating here, but I'm going to go with it anyway. I think there are maybe a handful of people who have still managing money today who have ever made real money owning gold. Number one. And I think there are probably, maybe more handfuls of people who understand the long-term relationship, what has transpired historically for gold and the dollar. However, I don't know that that should prohibit me or restrict me from being long gold here, despite the fact that the dollar is not weakening. I'm not certain in this environment in 2024 that I need to be restricted because the dollar is not corroborating gold. Maybe gold is telling us that the dollar will ultimately weaken. Maybe gold is telling us that real rates are going to come in, which I think they are. But I don't know that the dollar should restrict me. I mean, if I'm waiting for the dollar, I missed 7% in in the physical, and if I'm waiting for the dollar, I've missed a 30% in Harmony Mining over the last 2 months. So I don't know that I need to put that great of emphasis on it. I'll be aware of it, but I don't think that it should restrict me.
It's well said, John. And one of the things I love about your discipline, technical analysis, is trade what you see, not what you think. I mean, I've made tremendous mistakes in the past where I let the narrative get the better of me, and I'm ignoring the charts. I was listening to a podcast yesterday. It was really interesting. I'm trying to remember who it was, but they were pointing out, analogous to the correlation between, or the inverse correlation between the dollar and gold. They were looking at real yields, and they pointed out if you go back over time, there have been periods of time when real yields have gone up, and gold has gone up anyway. So it's not always the case. And like you say, maybe the price action in gold is portending lower real yields. And if you want to talk about narrative, I mean, I'm sure you're as well versed as I am. All the increasing liquidity and budget deficits and the need to monetize and yield curve control. You can make a pretty good story. Maybe the answer is all fiat currency goes down against gold. Who knows?
I maintain a spreadsheet with gold. Gold in currencies, other currencies outside of the dollar. And I'm pretty sure that the only currency that I maintain where gold has been, not particularly strong, in fact, weak, is against the Mexican peso.
Right. That's got to be telling us something.
So, I mean, and the Mexican peso is strong against the dollar. So gold strong in U.S. dollars, is strong in Indonesian rupee, is strong in China, is strong in euros, is strong in Canadian dollars, in sterling, in yen, in Singapore dollars. It's strong against all of those. Against Mexico, it's not strong. But, whatever argument wins or whatever narrative proves to be the case, I think gold is telling me that the narrative will solve for the metal. And so I'm a fan of a line from Paul Tudor Jones, which he said many years ago, price turns and then a narrative follows. And if it was good enough for him, it's good enough for me.
That's a good one. That's a good one. By the way, if anyone has any questions for John, please raise your hand. Otherwise, we'll just keep moving on here. So, John, one of the things you said earlier on at the top of the conversation, you're talking about this is not 2000 in terms of euphoria or market price action, whatever. You tease that out a little bit because I kind of remember it's almost like yesterday you and I knew each other and we were living through that. Is it the breadth of the market? Is it the sentiment? Is it the fact that these companies, some of the leading companies, are actually making money? I mean, to me, I agree with you. It just feels like a very different market than 2000. People always want to draw parallels because it makes it feel more comfortable. So we have a roadmap. Like we've seen this before, but no, it's always a little bit different.
It's always different, right? It's always different. So I'm just going to use a few illustrations. Number one, and maybe I'll play the age card here. I remember being in meetings in the late 90s, late 99 and early 2000. And if I had asked people in the meeting, and I did back then, how many people in here own Cisco, everybody's hand went up. If I do that today and I say, how many people in here own Japan, up 40% in the last year, nobody's hand goes up. If I ask how many people are overweight industrials, nobody's hand goes up. If I ask how many people, own financials here, nobody's overweight financials, nobody's hand goes up. Of course, people do own tech. There's no doubt about it. It's impossible not to own, but I don't know that it is owned to a greater degree than it was in the year 2000. And here's another example. I know this is ridiculous, but you could check your charts, and I'm pretty sure that this is going to be on the money. Right now, the Philadelphia Semiconductor Index is 26% above its 200-day moving average. In the year 2000, when the SOX was peaking, the index itself was 100% above its 200-day moving average. So in that
100%, 100%.
The index itself was 100% above its 200-day moving average.
The index, not one stock, the index.
That's correct. That's euphoria.
Wow.
So now, again, history doesn't have to repeat in detail, and we've all seen what Super Microcomputer has done. We've all seen what MicroStrategy has done, Meta, NVIDIA, etc. And while those advances have been spectacular, I mean,
Sorry, John. Did I wait? Sorry, can you hear me, John? I'm sorry.
Yes, can you hear me?
Yeah,
Can you
sorry.
hear
I think I fat fingered something. Go ahead. So you said, well, those advances have been spectacular. I believe I accidentally cut you off. Go ahead.
Okay, so while those advances have been spectacular for MicroStrategy, Meta, NVIDIA, I mean, some of those advances have been almost mythological. If anybody wants to take a look, please take a look at the chart for Abercrombie and Fitch. Abercrombie and Fitch, and I wrote this up, so I'm wrong. So I'm not telling you my greatest hits here. Abercrombie and Fitch was 100% above its 200-day moving average in early January. And I wrote this up and I sent it out to my distribution list. And I said, this is not a tech stock. It's not a biotech stock. It is a retail stock. I don't know that I've really seen a retail stock 100% or more above its 200-day moving average. Okay? So I'm wrong. The stock went from 100 to 140. So it was up another 40% after being 100% above its 200-day moving average. So I can't own a stock more than 100% or more above its 200-day moving average. I just can't do it. And so I think Abercrombie is a reduce at best. You'll see its momentum indicators are weakening here short term. You'll see that the stock was in sharply 2 weeks ago. I think it was down 20% over 4 days. And 2 days ago, it was down 10% just in one single day. And so I think it is kind of hard to continue to own a stock when it is this extended relative to its 200-day moving average, because the beta in your portfolio goes up a lot. So I think this is going to come in. The momentum indicators suggest it will, but there are not many ANFs. And I said when I identified this as being extended at 100% above its 200-day moving average, and I will just repeat, I was wrong because it went up another 40%. I said, is ANF the poster child for what we can expect for other stocks? Can other stocks get as overbought? And so far, the overboughts have continued. But this one especially looks a little bit concerning to me here. Check the daily MACD, check the daily chart, check the daily RSI, and it looks to me like there's going to be a corrective phase here. But when you have a stock that's 100% above its 200-day moving average, I think you have to do a great job owning it, managing it, your portfolio, and it's not against any, of the market edicts to say I should trim this. And I think this is going to be the case here.
Right. We'll get to Bill. He has a question, but one other question I had for you, John, before we go to Bill. I remember, who was it said it? Do more of what's working and less of what's not working.
That's a beautiful line. I actually think you said it.
I may have borrowed it from Dennis Gartman. I can't remember where it came from. But in any event, clearly there's been a lot that's been working. And let's talk about what's not been working. Like when you look at the short side, is it really much? It's been easy to make hay or pretty difficult to make hay on the short side?
I think it's pretty darn hard. I got lucky recently with Adobe, but I got unlucky with Oracle. So I think it's very difficult to make money on the short side. I think it's really hard. And I will also tell you, and if anybody wants to look at this chart, they can do it while I'm speaking. If not, they could check it, later on. I mean, if you look at Federal Express, which had a giant downside gap in December, stock didn't rally in late December. It didn't rally in January. It didn't rally in February, and then broke support at 240. It's below its 200-day, below its 50, below its 100-day. I said, my gosh, this to me looks like this has more downside. And then the stock kind of repaired itself, and then it got back above its moving averages, and then it went from 250, and it traded as high as 291 over the last week. And my point for mentioning this is I don't think downside gaps have as much magic in them with respect to shorting as they did in prior cycles. So the downside gap may have been because some pod shop was offside versus another pod shop, and then the selling pressure is kind of over to a great degree, except after that one day, and then the stock kind of rebuilds. And if you want to see another one, just put up the chart for Walmart. Walmart had a big downside gap in November, came in sharply into mid-December. And I got an email from a client, a customer of ours, and he said to me in January, what do you want to do with Walmart? And I said, I'm of two minds. My first mind is that the stock is going to fill the gap. I'm going to want to sell it as it fills the gap because it had a downside gap from November based on a fundamental piece of data. And he said, what's your second mind? My second mind is that algos and machines don't care anything about gaps. They don't know anything about them. And it wouldn't surprise me if Walmart went up and made a new all-time high. And luckily it did. But I think that's the environment we're in. We have to know which of the old rules to use and which of the old rules not to use, mostly because algos and machines are not aware of the old rules.
John, I remember you having a similar line about algos and machines, but I think it went a little bit differently a few years ago. I think I'm correct in attributing this to you. You spoke about algos and machines not getting emotional. They don't experience sentiment. I think that was from you. They're just methodical, mechanical.
Yeah, so I kind of go with this one. When we come into work to do our jobs or when we're looking at our personal portfolios, our decision tree may have 5 items on it, maybe. An algo's decision tree has, I don't know, 1,000, 2,000, 3,000 items on it. If one of them gets shut out, they just move to the next item. It's not emotional to them. They just move over to the next item. When one of our items on our decision tree gets the Hakeem Olajuwon treatment or Dikembe Mutombo treatment, we have to kind of rethink our thesis. So it's harder for us, and algos aren't burdened with that.
Yep, we've met the enemy, and it's
us.
me. Exactly. Hey, Bill, you got a question? You had your hand up. Bill, do you have a question for John? Bill? He's in the room as a speaker. I don't know what's going on. Okay, let's keep moving. I'd like to move back to energy. I know you're not a total believer, but the stocks, the chart of the XOP, it's about to break out. I think it was one of the things you highlighted last week. The commodity itself, I know it's got some work to do, but energy look like it's shaping up to you? Or do you think it's kind of on its last legs here?
I think it's shaping up, and it would not surprise me. In fact, I'm kind of estimating that the XLE, I'll use the XLE, is going to break out to a new high. It's been captured really over the most recent part of this cycle. Going back to 2022, the high for the XLE is right around 94. So, I mean, you're less than a point away. And the XLE has had kind of a checkered history up at the resistance because the resistance itself goes back to 2008. It made a minor new high in 2014, but reversed that pretty quickly. So this really is I'll use my own line here, a Brobdingnagian base that goes back to 2008. That's a long way. I think it's going to break out. I think oil is going to WTI will work higher, but the index itself, if you didn't know what the XLE was or the S&P energy sector was, I think you'd have to be long it just because of the way it's set up here. And the setup here, if you look at it on a monthly basis, has been fairly tight. I like tightening setups, either daily, weekly, or monthly. And this is a tightening setup on a monthly basis. And please consider, if you do check the long-term chart, in 2008, it had a short run to what was the 90 level, was reversed quickly. And then in 2014, it had a run to just about 100 or just over 100, reversed quickly. This time, this index, the S&P energy sector or the XLE ETF, has actually been consolidating, and it is a churning consolidation with a lot of agita since May of 2022. So if you're a base person like I am, you could say that this has been basing for almost 2 years. So I think that breakout's going to happen. So I think the XLE is in a good spot to be long.
Yeah, it's interesting too because you go back to your non-growth chart where you've got the three of them together. You've got what XLI, XLV, XLE. I mean, that's a great looking chart. But the interesting thing is, and you'll correct me on this because you're the man with the numbers, but the market cap of the energy sector, I think it was something you wrote or somebody wrote the other day. It's what, only 3% of the S&P or something like that, and I think Nvidia is bigger than the entire energy market, something crazy. So what it does to the overall indices, I don't know, but you've got enough stocks where the charts are looking pretty decent. So does that also lead you to think, by extension, that the equal weighted S&P RSP might outperform the market cap weighted S&P?
So
That's a harder call.
so just to complete it, so energy is about 4% of the S&P, still very
Okay.
small.
Okay.
Still very small. And I like the action in the equal weighted. The equal weighted, is also at a new high, and I don't know that it's going to outperform, but I think it has a pretty good chance to do well because I think tech and growth are not going to do very much better, and so that naturally would give other sectors a better chance, or an equal weighted version a better chance. And I think it's hard to lose when you're at new highs and you're in an uptrend, and the RSP solves for that. And it just completed its own base that went back to late 21. So this is kind of a fresh breakout. And in addition, George, to your RSP mention, I think people should take a look at the mid cap. The ETF is the MDY. That's also at a fresh breakout above its 2021 high. And kind of the last one in this grouping that hasn't done it is the Russell 2000. I don't know that the Russell's going to catch up in terms of performance, but again, I do think it's going to get back to the old highs from 2021, and that was 20% from the 2000 level. It's a little bit less now, but I think you still have a lot of room.
Sounds promising. Okay, we've got a couple of questions here. John, go first, and then Michael. John, floor is yours. John Green. MIA. Okay, Michael, how you doing? Good to see you.
I'm doing fine. So, John, I want to go way back. The greatest chart I ever saw you put out in 1999. I think it was 5 standard deviations of the total return of the Nasdaq relative to the S&P. I think it was. It was like It was the most impressive chart I've ever seen in my life, and it affected my behavior in terms of being concerned about the potential for a major crash in the market, which is, of course, what happened. So I want to thank you for that.
Thank you.
But as an investor more than a trader, should I focus more on the Brobdingnagian charts?
Michael, thanks very, very much for the kind words, and thanks for the question. So I consider myself a trender and not a trader. And I found, and I'm talking about myself here, not anybody else, that the fewer decisions I make, the better I do. And I think that I screw myself up when I try to get a little bit too cute, just because something daily overbought. Sometimes with my own account, I probably get a little bit too cute, and I should just leave it alone. So I'm a big fan of the Brobdingnagian base, or big bases, and I think the breakout from such a setup is the manifestation of a fundamental story. And I think that's the biggest and most important takeaway from big bases. I'm going to give you an example right here. So I would suggest, to answer your question completely, that it's a place that I focus on, and it kind of fits my overall personality as well. So I'm satisfied by it, and the performance of bases and breakouts is also satisfying. And then I'm going to mention two stocks that I think are building bases. The first one is LyondellBasell, which is a chemical company. LYB is the symbol. The stock is breaking out of a base right here that goes back to June of 22, but it has a much bigger base that goes back to 2014. So I would suggest that if anybody can do their due diligence, they should probably take a look at LYB, because this does have a big base, and price action is improving a lot, which is a very encouraging sign. And by itself, I could buy it just using the daily chart, but I think the monthly chart makes me even more interested. And it probably doesn't hurt any of us that it has a near 5% dividend yield. And then the second one that I'll mention, because I think it is also building a big base, is Honeywell. Now, historically, Honeywell was a fantastic bellwether for the S&P 500, but that's no longer the case because the S&P is 40% weighted to tech. But be that as it may, Honeywell is building a big base. It's gone sideways really since early 2022, and my momentum indicator, which was excessively overbought in summer of 21, has removed or ameliorated the overbought condition, and it's improving. So I like both of those stocks because I think they're building big bases, and I don't have to chase them. They give me a chance to do my homework, and it gives me a chance to kind of think about looking at them in a next consolidation or on any pullback because they're within the construct of a big base. So that's kind of my calling card, and so much so that I've actually trademarked the phrase Brobdingnagian base. My son helped me with it. He's a lawyer, so I don't know if I have him on retainer, but I probably do.
That's great.
Thank you
That's
so much
great.
from a Philly sports fan.
Oh, thanks a
That's
lot.
great.
Thank you very
That's
much.
great. All right. Thanks for the question, Michael. John, are you there, John Green?
Yeah, I'm here. Can you hear me now?
Yeah, we can hear you now. Welcome.
Okay, apologize. I was on mute. I just have two observations. George was in our offices back in 2000 when I was at Citigroup when my boss was asking him about e-toys. I specifically remember the meeting or coming by, but my observation is on why the market keeps going up is that the two things really: supply of stock, obviously in the 99 2000 period was off the charts. The second thing is more recently, I've talked to more and more people about this. The money flow that was sort of caught on to China is gone. I mean, nobody in their right mind is putting money in China, even, well, it may be cheap and everything like that, but as a permanent investment. So, and with regard to the algos, the other thing is, because I've been trying to short stuff recently too, you can, even companies you identify when you try to short them, if the SPY or Qs start running, they everything just gets jammed up. And so I don't have the chart, but there somebody has a chart. One of the places in Connecticut that the percentage of passive money, and when I say passive, I know there's ETFs, but I'm talking specifically the spiders or the Qs, is just so enormous relative to when money was run by people that cared about doing the work, I think.
100%. John, you concur with that?
Yeah, I think those are very good points, and I think it's hard to fight that tide. Now, what we know, because we're students of market history, that ultimately, these things do run into some troubles. But I think it's hard to fight against that. What John Green had just mentioned.
Thanks for that, John. Appreciate it. John Green and John Roque. Oh, here, my friend. Good to see you. A long time. How are you? Oh, here, you there?
Hey, I'm here, George. How are you guys?
Good, man. Good, man. What's going on? What's
cooking?
You got a question for John?
We got a bull market on our hands, guys.
Yep.
I just hopped in. I don't know what was covered, but whatever was covered, I'm sure I agree with it. One thing I've
You're bullish.
noticed was, I don't know if you guys have covered this. This just started a few minutes ago, but if you look at the S&P 500, infotech is now 30%, right? Tech. So, followed by financial. So you have two sectors really kind of, leading the charge here. And if you look at kind of the bottom sectors, the very bottom, energy being one of them, it's still less than 4%. So I think I don't know if you guys have covered energy yet, but I think the place to be, and I think continues to be, is areas the sector of energy. So broadly speaking, I would look at like refining and anything downstream.
Yeah, John, I think we did
Oh, you
touch on
did?
that
Okay.
earlier, and yeah, John's pretty optimistic on that area. I mean, I know here you've been sort of in a lot of the basic
We
materials
are. Yep.
value. Yeah, and it's from a fundamental basis, things are the charts. I mean, John, has been touched on that, but fundamentally, you think things are shaping up in a lot of those subsectors.
Yeah, I think. Listen, I'm just looking at. I'm in the office today. I'm looking at our portfolio live as we speak. Pretty much everything green today, like literally everything except for one stock. And we have names that are anywhere from 2% movers today to 6% movers today, and really kind of everything was green across the board. So
Right.
it's I don't know. You look at the Dow was up, S&P was up, transports were up, stocks were up. Literally everything is up. So I think everybody got a little a breather from the Fed last week, and I think I don't know. I look. Your guess is as good as mine as how far we can go here. But it's getting a little long in the tooth. I mean, you're getting. It's like a pyramid. You're getting the closer to the top, the narrower the breadth, and the narrower the participation, and we're starting to see it. It's hard to say when that top becomes so pointy that it pops the bubble, but you have to be prepared for it. It's something to think about anyway.
Fair enough. So thanks for that. So John, one more question for you, unless there's any other folks out there that want to have a question. So John, the market's been incredibly powerful off the October lows, and is it the case that if the market's going to correct, would you expect to see it become a little bit distributed first? I mean, isn't it kind of unlikely that things go straight up and straight down, and you really haven't seen much distribution? So do you think your technical indicators looking for distribution, decreasing number of new highs, increasing number of new lows, whatever, that'll give you proper warning before anything more serious is going to set in?
I'm going to answer it in a different way to start. And if you go back to 1960, and you look at the S&P 500, I believe the S&P 500 gets to a 2 standard deviation move above its 40-week moving average when it's about 18% above its 40-week moving average. And so through the end of last week's close, it was 13% above its 40-week moving average, which is a more than 1 standard deviation move. But the S&P can get to a 2 standard deviation move, which is, again, about 18% above its 40-week moving average. So I don't. Hold on a second. Thank you very much. Okay, thank you. I don't think that there's an explicitly negative reason here, but as the prior questioner or speaker just said, you're going to get kind of a extended advance when the S&P gets to be about 18% above its 40-week moving average, but we're not there yet. So I would expect as that occurs that you would get fewer stocks participating and the number of new highs would weaken or deteriorate. But again, that's, I think it's hard to play for that if it's not yet occurring.
Got it. Makes sense. John, this has been terrific. Seriously, you've covered so much ground in such a short period of time. It's wonderful. Appreciate your insightful comments, your generosity. I know
Hey, George.
everyone loves hearing you, and hopefully we'll have you back before
Hey,
too
George,
long. And
let me
yeah,
just throw a
yeah,
question out there. I don't know if you guys,
sure.
what do you guys think this move in gold is signaling here? I mean, we've had a kind of a move out of AI. The AI train seems to be kind of slowing, and the Bitcoin train has kind of picked up steam.
Yeah.
But
So, here. How about you and I talk offline, because we did spend a
oh, you
considerable
did?
amount of time
Well,
on
I'll
gold.
listen to the
Yeah.
recording. That's okay. Yeah.
Yeah. Okay. Fine. Cool. All right. Anyway, John, thanks so much for all your time.
Thank
Very
you,
generous
George.
of you.
Thanks for having
Yeah.
me. Always a pleasure to speak with you. Hope
Yeah.
to see
And
you in person soon.
we'll see you soon. Thanks, everyone. Good night. Talk
Thank
to
you,
you soon.
everybody.
Bye-bye. Bye. Bye.